Is the Santa rally already over? Is the recovery from the correction already over? Oh my God, we had a negative 0.85% day today in the S&P 500. This is being recorded on November 9th, 2023. So I'm here to answer this tiny red candle for you. No, I'm here to give you actual analysis and provide more context as to whether everybody can see this resistance area, obviously, as to whether this is signaling something bigger than just a pullback of the rally that we saw, which was a rally that was a rebound of the recent correction. We've also got to uncover the really important Jerome Powell speech that he gave today at the IMF. His last words were, just close the door. If you have no idea what I'm talking about, we'll get into it. Tesla also downgraded today by HSBC. They definitely have some nerve downgrading. HSBC was infamously tied to the cartels and admitted so and had to pay a fine. So it's funny that they get to point their finger downgrading and upgrading people or companies. And part of the reason that the market actually dropped today was due to the 30-year bond auction. So we will go over that. Is this something to worry about? Is there a bigger implication here, or was it just a typical, subpar 30-year bond auction? But mainly you guys are here for the analysis, so let's get right into it. Actually, before I get into it, I just want to make sure that you guys get your name on this wait list. On Black Friday, we will be running our biggest mastermind sale that we've ever run, and the only way that you will see that is if you are on this wait list. So make sure that you get your name on this wait list. It's in the link below. Let's get right into it. All right. So as I said today, miraculously after 1, 2, 3, 4, 5, 6, 7, 8, I think that was the most consecutive green candles since 2021. 8 days of gains in a row on the S&P 500. The NASDAQ, I believe, had 9. We're finally seeing a tiny red candle here. Now, this definitely does look intimidating because it looks like an engulfing candle, right? It's engulfing the last 3 candles behind it. However, as I posted on the Discord today, I said this could be a 3-line strike. Now, admittedly, I'm not a candlestick trader, and I think it is one of the worst ways to trade on its own, obviously, unless you have a set of really ironclad confluences. But this is a 3-line strike where you have 3 bullish candles followed by what looks like an engulfing candle. But in actuality, it is just a pullback before a continuation. This is a 3-line strike here. Also, it's important to note, actually, let me pull up the SPY chart. It's important to note that we could not close below the weekly candle, right? So we could not close below Monday's candle and definitely not below Friday's candle, which we see here, which started this gap uptrend, right? So this to me still doesn't confirm anything bearish of the sorts, even in the short term. This is obviously just a continuation of a trend that you see here, this trend line. We were coming up on trend line resistance. And if you look at the QQQ, actually, you could see that we comfortably broke out of this trend and are retesting it as support. So I don't think this is anything emblematic of, of concern here. However, what I would say is I do think that a pullback would be healthier, right? Especially if you get a pattern that resembles sort of an inverse head and shoulders, where this right shoulder of the inverse head and shoulders drops down to at least the 50% retracement point. I do tend to like to see that. It's not a necessity, but I do tend to like to see that before comfortably going long again. Like if you ask me to go long from here, just like when I said it's suboptimal to go short from here, it's suboptimal to go long from here unless you were already in a long. That doesn't mean that we can't see upside or that we can't see a further continuation. It's just what is optimal, right? And for me, it would be an optimal long or a new position to establish a new position. If we got to around the 0.5 fib, we would cover a couple of gaps and we would be at the 200-day moving average, right? We're now sitting back at the 50 moving average. It is not uncommon to go below it. I would not be surprised if we went below it. And I would feel actually much more comfortable if we fell to around this level before taking another long. For me, in terms of swing trading, this is a do-nothing day. Day trading, a completely different story. But swing trading, where I'm holding for multiple days, this is a do-nothing area right here. And also context is important. As I've shared with you in the last update that I did, Declines of 5 to 10% take an average of a month to recover. So it is very much like, idiots on Twitter who want to say, I called the bearish reversal, or I called the bull market, or whatever. Every red candle, there's going to be celebrations. Every green candle, there's going to be celebrations, right? It's very common to react to this stuff. But, if it takes a month to recover, how do you know the recovery won't look like this? Maybe a little bit up, a little bit sideways, more up. You don't need to react to every goddamn candle, right? There are times where it's optimal to open a short. There are times when it's optimal to open a long. That's all I care about. Now, for the long term, as I said, 410 is a major buy point, and that is if you are a long-term investor. So it's important to separate the two between swing trading and long-term investing, and day trading, which is the third element, right? And day trading is obviously something that I'm very active in as well, as you guys know. So make sure you do click that link in the description, get your name on the wait list. So why did the market drop today? Well, apparently it's because there was a 30-year treasury auction that didn't go so well. But everybody became a bond expert today, right? As I said on Twitter, make sure that you're following me on Twitter for free daily trading and finance content. But I just posted this. I said FinTwit miraculously became 30-year bond auction experts today. From that article, that Barron's article that I showed you, if you take a look at typical 30-year auctions, it says that only 3 of the last 14 November auctions of 30-year debt have been strong. Since the beginning of 2018, just 26% of new 30-year debt issuances have been strong as well, right? So not only is November terrible for 30-year bond auctions, but in general, since 2018, most 30-year bond auctions are terrible. There isn't much demand for 30-year debt. Obviously, the Treasury gets to decide which treasuries it wants to issue. For some reason, it keeps issuing 30 years, even though nobody wants it. But the reason that a bond auction would be disastrous for stocks, or, I guess negative for stocks if it doesn't go well, is because when bond auctions fail, what happens to yields? When bond auctions fail, that is when you typically see yields. Here's the 10-year yield. We could switch to the 30-year yield so that we stay on topic and talk about apples to apples. But if you look at the 30-year yield, this was today, right? We saw a spike of 3.25% on the 30-year yield. So when auctions don't go so well, meaning when buyers or traders do not buy bonds that are issued in a new auction, then the yields spike, right? Because the prices tank when there's no demand. Prices tank, the yields spike in order to attract more buyers, right? Because there's an inverse relationship between bond prices and bond yields. So when yields go up, then that puts pressure on the stock market, obviously, right? We all know the relationship between yields and stock prices. With rising yields, there is a short-term decline in stock prices. But as you can see, with rising yields, the stock market can also go up. From January, we've had rising yields steadily. It's just when there is a shock to the yields, meaning if yields spike today, then stock prices today will likely fall. It does not usually have long-term effects on stocks. So just to summarize my analysis, we don't know yet. This can easily be a 3-line strike, as I said, a bullish 3-line strike, and we could just see a continuation. We could see some sideways, some ugliness. In my view, I don't think this is any cause for concern. I would be much happier if we can get a decline, like I said, and this turns into an inverted head and shoulders for the continuation of the rally. We're not due for Q4 earnings until January, so we have quite a bit. And as I said, I think the Fed is going to skip on December 13th. So I don't think yields are going to rise significantly unless there's some sort of black swan event. Plus, if you look at the 10-year yield, we did break below. And I do think we will climb up, but time will tell if we actually can get back up to the 5% mark on the 10-year yield, or if we'll just slam against this resistance line. I do think that the yield curve has to uninvert. This might take a pretty long time to happen. Let me move my head out of the way. Yield curve is going back down, even more negative, right? There was a time when it looked like we were close to uninverting when it was negative 0.14, But now it looks like we are going back down, mainly because the 2-year is stubborn and the 10-year has dropped. So this could take a while to invert. I know that people are waiting for it as if it's going to happen tomorrow, but it could take months and months before it inverts. And for it to invert, eventually the 10-year yield has to be above the 2-year yield, right? And when it finally uninverts is when we can then start talking about a recession. So a recession could be a very long time away, right? People can sort of predict when a recession is going to happen in general, but it's one of the worst things to predict on the nose. So I could tell you 2024, I'm expecting a recession. Whether it's July or December, I couldn't tell you, right? It could even be stretched to 2025. These things take much, much longer than people think. And it's only because we're tracking this stuff every day that we want it to happen tomorrow, right? One more thing I wanted to highlight, put call ratio is still above 1. And I think that when this happens, the people that are holding puts, the short sellers, will tend to get squeezed out until this drops below 1. So far, I don't have any view that this is going to turn into more than just a minor pullback, right? And I do think that those shorts, that put call ratio has to fall below 1, or I don't think we can get, I don't think the market can tank with that put call ratio disproportionately high. Now, before I talk about Tesla and Tesla's downgrade, let's just see the important words that Jerome Powell had to say today at the IMF conference.
Okay, thank you. You are putting us at
Thank you very much.
disaster.
Yes, thank you very much.
Climate change
Yep.
will
Thank you. Just close the fucking door. Close the door.
He said, just close the fucking door. If you didn't know what was going on, he was giving a speech about the economy at the IMF, and climate activists apparently interrupted the speech, right? So he wasn't able to give the full speech, and then they cut the camera.
Thank you.
And that's when he said, just close the fucking door. It was so funny. That became sort of like an instant meme online, right? And even I tweeted, I said, just close the fucking door. Jerome Powell's last words before the stock market crashed in 2023. Anyway, just a moment of levity, nothing to do with analysis. It was hilarious. All right, so Tesla was downgraded. Now, here's what's important to note. Tesla was downgraded by HSBC. Hang on, this is the right article. So it was downgraded by HSBC to a price target of 146. Tesla is currently trading at 209. Now, does that mean that Tesla will get to 146? No. As a matter of fact, Tesla in early 2023, in June 2023, was downgraded by Morgan Stanley, Goldman Sachs, and Barclays, right? And it just continued to rally. As a matter of fact, stocks rarely get to the downgrade profit target. And it's important to note that only 7 of the 46 FactSet analysts, only 7 of them, as a matter of fact, I think it's in this article, have negative ratings on Tesla. So as you can see here, it says of the 46 analysts polled by FactSet, 20 have a buy or equivalent rating on Tesla stock, 19 have a hold, only 7 have a sell or equivalent rating. So HSBC is just one of the few that actually has a sell rating on Tesla. And as you know, sell ratings in the past haven't really led to anything except for interim downturns on the day or a couple days after. I wouldn't put much weight into it. As a matter of fact, Tesla dropped 5.5%, closed the gap here from the beginning of November. I'm definitely looking for Tesla to start basing out, and I will likely open up new positions on Tesla pretty soon. I don't think they're going to get to that 146 target in the short term. And the last downgrade that it got back in 2023 from Goldman Sachs, Tesla was down 6% on one day before rallying another 25%. So don't put so much weight into these singular downgrades, right? They are actually moments, in my view, to take advantage of the irrational move that happens on the day of the downgrade. Now, I did a whole write-up on bonds and why I think bonds are going to be one of the best investments going forward, especially because we have seen an irrational crash in bonds, the worst crash in bonds. And as you know, I like to take advantage of fear and of extreme conditions, right? So just like if there was the worst bear market in stocks, I would try to buy as much as I could. Same thing with bonds. I do think that there is an opportunity in bonds to make life-changing type of money for the mid to long term. So I did a whole write-up on bonds here, and I also did a write-up on oil and a write-up on gold, which two things that I'm looking at intently as well. So it's not just day trades that we send out in the Traveling Trader Academy. We definitely send out long-term holds. We definitely try to educate people on different commodities such as oil, gold, and then now obviously bonds, which is a world that most people didn't even know existed or that they can even take a part in, right? So make sure, again, that if you want to be a part of the Academy and you want to be a part of the mastermind where you get access to all previous recordings, all future masterminds, our next mastermind is going to start in a couple of weeks. Make sure that you get your name on that wait list below. People outside of that wait list will not see the Black Friday deal, only people on that wait list. So make sure you get yourself on the wait list or sign up for the monthly memberships, which don't get you access to the mastermind, but at least give you access to the monthly memberships where you get the day trades, the long-term analysis, etc. Look forward to seeing you there. If you got anything out of this video, leave it a big fat thumbs up. Let me know in the comment section below. Do you think this is just a minor pullback before a run higher? Do you think this is the start of something more dire? Would love to hear from you. Hit that thumbs up, subscribe to the channel, hit that notification bell. Stay safe out there, traders. Peace.